This is Robert Kraft, and I'm your host on SNN Network. And with me today, I had him on as a guest on the podcast, and he's been putting out some very timely YouTube videos very recently. And I highly recommend everybody go follow his YouTube channel because I'm happen to be a big fan. And with that, I have Gary Mishuris. He is the managing director and CIO of Silver Ring Value Partners. Gary, good to see you. How you doing?
Same here. Great. We picked a good time to do this. A lot of interesting things happening.
A lot of interesting things. I mean, I don't. I think we could talk for hours about everything that's going on, but we'll.
We probably could.
but we'll try and stay topic specific.
Sure.
But first, before I get into some questions that I have that are based on some of these interviews or videos that you just put out on YouTube, what's your general take? I mean, how are you seeing what's going on in the markets in the last, say, couple weeks?
Yeah, no, so look, I mean, I think Ben Graham originally kind of coined this analogy in Intelligent Investor where you have this Mr. Market and you have, basically a manic partner who one day, offers to buy your business from you at a, crazy price, and next day he wants to sell you that same, share in the business at also a crazy price. And that analogy is really useful because literally we have days where in the 2 day span the markets are more than 10% apart, right? And because people are scared, and there's probably legitimate things to be scared about. And I don't want to in any way kind of, sweep under the rug what's happening or minimize it because people are dying. This is serious. My wife's a doctor. I know she's working with her hospital staff to prepare, here in Boston. But at the end of the day, look, one very good way of thinking about things like this is if you fast forward 3 years from now and look back, how much will this have affected the businesses you're invested in? And so I'll give you a range of scenarios because I think you always want to think in a range. You never want to say, I know the answer, I know the future, because nobody knows the future. But you can think of a range, and the range is something like this. Let's paint like the worst case. The worst case might be we have almost everyone gets infected. There's a 2 to 3% death rate, which means that something like 10 million people die. And this puts us in a severe recession, and we stay there for 1, 2, 3 years. That's the worst case, right? The best case is we contain it quickly. Relatively few people die. There is some slowdown in travel-related industries, but it doesn't spread to the rest of the economy, and we recover, and by the summer we're fine. So those are the kind of the two extremes that we can use to bookend the likely range of outcomes. And the probability is that the reality is probably going to be somewhere in the middle. So now, what do you do with that as an investor? I think you have to have a portfolio that can do at least okay in any of those scenarios. And that's tough, right? Because I think we've had this very optimistic market. I wouldn't call it a bubble going into this, although I think the bond markets, especially in Europe, but in some degree in the US, were in a bubble and maybe still are. And the equity markets were not in the bubble, in my view, but they were kind of on the optimistic side of the range of possible outcomes. And you had these businesses with no profits, 20 times revenue, 10 times revenue, on the hopes and dreams that one day they'll be great. And now reality is starting to sink in, and the momentum that we've had in this market for now years is starting to reverse. And as Buffett likes to say, the tide's going out, and you're going to see who is swimming naked and who is prepared. I believe that my partnership is prepared, but time will tell.
Absolutely. I mean, it's interesting that you brought up this idea of a bubble because you just posted a video. I think it was a couple weeks ago or maybe a month or two ago
Yeah.
about asking that question. Are we in a bubble? Like, how should we think about bubbles? I mean, so maybe let's dive a little deeper there. I mean, you're saying that we're not necessarily in a bubble here. Even though there's a lot of what I think you said optimism, right, right, and so you know, how do you then tell the difference between okay, this was a bubble. Right now, it's bubble-ish.
Right. Bubblicious, like a flavor,
Like
yeah,
a
of a bubble gum.
flavor.
Yeah. I mean, so I think, look, I think to me a bubble is prices that are so irrational they could not possibly be true. Or there's the odds are so slim as to be close to impossible, right? So for me, for instance, the reason I say parts of the credit markets are in a bubble is because if we, as a group of investors, believe, which I think we do, that inflation is going to be positive, it makes no sense to give money to the government at negative rates, right? It's just nonsensical because investing is at the end of the day, you give out some amount of money today to get a higher purchasing power in the future, right? So if you're giving out 100 euros and you're not going to get in nominal terms in 10 years 90 euros back, and by the way, you expect that inflation might be some number that's greater than zero, which means that 90 euros in 10 years will purchase less than 90 euros will purchase today. That makes no sense. That's irrational behavior, right? And it's manipulation by the governments and so forth, right? Trying to prop up the economy by lowering rates and increasing asset prices. So that makes no sense. Now, if you take a stock, a growth stock that's trading at 30, 40, 50 times earnings, that is not irrational, right? There are some set of assumptions that could make that business be worth that. Now, are they likely for a large number of stocks? They are very unlikely, but it's not impossible. Now, you take something, I'm actually going to stay away from specific companies, but you take something like, a company that created a new category in food. I think you might know, something that doesn't involve meat. So I'll let you guess what the companies are. Is it possible that some of these businesses are going to be extremely valuable? Of course it is. Is that necessarily the most likely scenario? Not, at least based on the evidence we've seen so far. So that's why I think is a difference. The difference is those businesses could be worth what they're trading for more, but that's a very much against the odds kind of wager. So I think the bad news for investors, unfortunately, is that we went from a very optimistically priced market to, on the whole, just a somewhat less optimistic, market. The market was up 30% plus in the U.S. last year, 31%. Year to date, it was down something like 15%. So this is by no means the end of it if there is going to be a recession, if there is going to be a meaningful kind of multiplier effect on people staying home and so forth. But that's not the only probability. So I think the reason we're seeing plus 7% days, minus 7% days, whatnot, is people don't know. And I think this is the perfect environment to be a value investor, to have a disciplined process that you can rely on. So you're not reading the news stream. You're not saying, oh, what do I buy today? What do I do? What happened? You have a process that you've kind of committed to. You're ready. You've done your homework. And now you just stay calm and just execute.
Gotcha. Well, that ties into my next question because as some of my audience may know, you also have the website Behavioral Investor, talking, and you're really passionate about behavioral investing. So, in times like these where it's just so highly volatile. I mean, let's go through what are some of like the common mistakes that investors make, just based on what they're seeing in the news, and then maybe some things that like you do when it's times like these that,
Sure.
You're able to maintain your chill, I guess you'd say.
Yeah, no, I'll actually, so, I mean, I think I'm a behavioral value investor. I talked a lot about these and relating them to investing. I'm actually going to start with the tail end of your question. This is maybe in the TMI category, but I'm an avid beginner in bonsai, which is this art of miniature Japanese trees, and taking, basically creating a miniature representation of nature. So, I don't want your listeners to think I'm kind of like lazy and not doing the work. I'm doing a lot of work. But if you recall that day the other day when the market was down almost 8%, I did what I needed to do. I put a few buy orders in based on my process, which we can talk about in a minute, and then I went and I made a little pine tree, and that sounds like insane, right? Like, because you're supposed to be in a suit, you're supposed to be like wheeling and dealing, but like let's face it, what are you going to do? Like, you're going to stare at the screen and you're going to get worked up? I think you have to find some activity which for you allows you to maintain emotional equilibrium. So that's the baseline, because all these biases and these tools to fight them don't work if you're like reptilian brain, what I call it, switched on, and you're just like in the fear greed mode with the market, getting whiplashed by the same emotional forces. Now let's talk about specific biases. By the way, I'm not saying that everyone needs to get into bonsai. I'm saying that someone it might be meditation, for someone it might be a walk in nature, for someone it might even be an ice cream. I don't know. Although I think nature is a little healthier, but I think you get the point. Now, I think the biggest thing right now that is causing behavioral effect is social proof. And what I mean by that is, social proof basically is we believe that something is true because others are doing it. And the origin of it is obviously evolutionary. Basically, 10 guys heard the rustling in the forest. The guys who assumed it's a tiger and ran. basically assumed that survived, and the guy who thought ads got eaten some percentage of the time. So people learned when one guy runs and then the second guy runs, you don't look to see if the tiger is there, you just run, right? So we've seen this in stocks where I have a stock, I'm not going to name it, that's down by 2/3. I think it was undervalued since at original price. I think it's massively undervalued now, and I think the main reason why people are selling it is it went down a bunch. So people saying, "Oh, there must be something wrong. Someone knows something I don't. Let me sell first and ask questions later." Other people see the next leg down, say, "Oh, wait a second. Now it's down 20%. Let me sell some." So that is kind of falling prey to those ingrained instincts, and that's a terrible way to invest. By the way, I could be wrong on that stock. That's why I have more than one. I'm humble enough after 2 decades of investing to realize I can be wrong and then you want investment. However, the process is terrible, especially in a panic and like this. The way you want to do it is you want to have objective things to hang your head on. For me, for every investment, I have a range of values, and I have different points at which I would make it different position sizes, which makes it actually really simple. By the way, am I scared? Of course I'm scared. Everyone is scared. If you're not scared, you're stupid, as my physics teacher used to say, because it is scary. The question is, are you scared and acting stupid, or are you scared but acting rationally? And I'm scared but acting rationally. And to me, that means I'm slowly adding. Every time it goes down, I add a little bit more because it's a little bit more attractive. I've done the analysis for that specific stock. I've done the scenario before any of this started, assuming that another 08, 09 size recession starts immediately, and made sure that the business can withstand that. By the way, now is not the time to redo that analysis. The time to do the analysis was when everything was calm, which is when I did it. Now is the time to trust yourself and your work and act the way you planned you would act if there is a price dislocation. So I think social proof is, I would say, the number one. I think the opposite danger right now is anchoring. And by anchoring, I mean like you reach a certain conclusion, right? And new evidence comes, but you disregard it because you've made your initial conclusion, and that's kind of causing you to not change your mind no matter what. So I think there are some businesses that as time progresses, you're going to learn things about you didn't know, and their value might be impaired. Maybe some travel companies will go bankrupt, right? Like how long, by the way, so I don't have any investments in the airlines, although I am looking at the airlines, part of the reason because there's distress. But I asked a friend, what would it take for some of these companies to go bankrupt? Like you have to at least understand that. I'm not saying they will go bankrupt. They might be totally fine, or they might go bankrupt. Because by the way, going bankrupt doesn't mean that there are no more airlines. It just means that the equity gets wiped out, and you get a really bad outcome. But in 2 years we're still gonna fly. But I think that you want to be open-minded to the possibility. Like let's say you were an airline investor, maybe things have changed, maybe they haven't, but you want to keep an open mind and not just anchor that I like airlines and I'm going to double down every time it goes down, because you could double down to zero. There was a joke. I started my career almost 20 years ago at Fidelity. There was this joke about a PM who lost half his fund in a 5% position. How did he do that? Well, it was a 5% position, got cut in half. He made it 5% again, got cut in half again, and so forth. So you want to that tension between conviction on the one hand and flexibility in terms of rationally responding to evidence. That is the secret sauce to successful investing, in my view.
So how would you talk to, let's say we have people now that, maybe are watching this interview, or maybe some other interviews I've done with value investors who, have probably more likely than not done the work during the calm periods. And, when these times happen, they're like, all right, let's see what deals we got today,
That's right.
So what do you say to the investors that maybe are newer or weren't looking at the market, but now they have a friend who's a fund manager at wherever, and they're like, yo, dude, you should look at all these names. Like they're trading at this and now they're 20% less. Like just go do it. What would you say to them?
I mean, I would say that, you want to understand your own circle of competence, right? So I think that very few people are good at being direct investors. And I think also, by the way, very few people are good at picking managers either, because there's a certain skill set that you need to assess, a manager's process, their temperament, which, by the way, I always tell my investors that one of my biggest competitive advantages is temperament. And that somehow sometimes hard to prove. Like, what is temperament anyway? Well, this is temperament. Like, temperament is actually acting calmly when crazy things are happening all around you, right? So I think the person who is just starting to look at stocks, I would say, do you really have the expertise to do it? Do you also have the stomach to watch one investment? Let's say you buy an investment, tomorrow goes down 50%. How do you feel? How do you act? That's key. So if you think you have a process in the template and you just happen to have not done the homework, okay, there's still time, because guess what? I mean, I'm listening to like the updates we get from friends who are doctors, and schools is trying to shut down, travel is being kind of stuff. This is not over. This is not some fake news. This is this is the real thing. We just don't know how the magnitude is going to be. So the last thing you want to do is go full board, do some quick work, and then boom, all in on the first 2 or 3 stocks. That would be a terrible idea. Now, let's go to the other extreme of passive investing, right? So passive investing has been more and more popular, and I think deservedly so, because most people can't successfully invest in stocks better than the market, and they can't pick managers better than the market. So what's left is a low-cost passive approach, which totally makes sense for, I believe, a good majority of people. That's my honest belief, despite the fact that I'm an active manager. I think most people shouldn't be investing with people like me. Most people should be dollar cost averaging and doing that. And I think if that's your situation, you should stick to your plan. And that plan might be just a dollar cost average. That means, let's say you're working and you're getting a paycheck, you're saving X percent, and you said you're going to dollar cost average. The worst thing you can do is say, well, I was going to dollar cost average, except now because it's scary. Because no, you cannot do that. You had a plan. It's a simple plan. I'm going to buy, just let's pretend, the Vanguard Total Market Index Fund with all my savings. Great, keep doing it. Market goes down another 20%, keep doing it. Whatever it is, keep doing it, because that's how dollar cost averaging works. So you get the average price. The way you don't get the average price is if you stop. I'll tell you a quick story. I went to MIT for my undergrad. I have a friend who is very smart, successful classmate of mine. And usually, I'm actually surprised I haven't heard from him this time. Usually, when one of these market extremes happens, he calls me panicking. He would say, when the market is at the peak, he says, Gary, I think I should be all in stocks, right? No bonds. And then when the market is in turmoil and like 08, 09, he was saying, oh my God, should I go all into bonds? What do? I'm looking at my 401k statement. It's all down. So his instincts, despite very high IQ, are telling him to do the opposite. The way you fight that is you pre-commit. You say, no matter what I see out there, whether it's the market, if the S&P indicates at 1,000, you're just going to dollar cost average. So I think as a baseline for someone who doesn't have the expertise to invest or invest with the manager, that is perfectly fine. But you have to expect a long time. We could easily go into the recession. My background, when I started investing, was 2001. I started Fidelity as a young associate. I started in June, and September, we are all on the 24th floor of One Federal Street in Boston. And I see people gathered around the conference room, and they're watching the news. And I come in, and there's more and more people. And we see the first plane hit, the second plane hit. Management immediately tells us to go home. By the way, there's no cell phone reception because the wireless circuits got overloaded, so you can't even check with our loved ones. Like, we are all imagining all kinds of horror stories that, like, acid rain. Like, people are like speculating wildly about what happens next. So, by the way, that's a useful thing to go through because it teaches your mind how to deal with these kind of panic-like scenarios. By the way, the economy was already slowing down, and that's very analogous to what's happening this time. The economy was already slowing down. Business wasn't super brisk. We weren't in a 3-4% real GDP environment. And the shock, which killed 3,500 people, which is a lot of people, trust me. I was in the World Trade Center a week before the September 11th attack on the very high floor, visiting Lehman Brothers. So I had like a very personal sense of fear. Wow, if it had been a week later. But this could kill a lot more than 3,500 people if it's not contained. So this could easily push us into the a recession. So I think if you have this idea that you're going to dollar cost average, you cannot give up. You have to basically keep doing it, understanding that you might have to do it for 2-3 years. Now, the flip side of that is you absolutely should not invest any capital into the market that you need over the next 3 years. You should have a cash reserve. You should have money set up for your needs that you're not going to need, because the last thing you want, and I always talk about this, is to be a forced seller. Because that's how you lose. By the way, that's why I don't use leverage at the partnership. So like some smarter people than me say, "Oh, I'm going to lever up. I'm going to get 2x the return." Maybe, or maybe you'll get wiped out because temporarily your portfolio goes down a lot. You get margin calls and you're forced to sell out. So I've had actually a couple of my partners add to the partnership in recent days, which is great because it shows the kind of long-term minded people that I have invested with me. And it helps me because these are people who are adding capital just as I see better opportunities. No one is pulling capital out. No one is worried about the market. And I have no leverage, so nobody can yank my capital away. So I truly have a long-term horizon. And as an individual investor, you don't want to give that up. So have that cash reserve. And by the way, maybe you want to have a slightly higher cash reserve, but you don't want to use it as an excuse not to invest in the stock market, because longer term, that's the highest source of returns.
Yep. So with that, Gary, where can my audience go and find more information about Silver Ring Value Partners, as well as your YouTube channel as well?
Sure. So my YouTube channel, basically, if you just look for Gary Mishuris, you should be able to find it there. Behavioralvalueinvestor.com and silverringvaluepartners.com. So there's a lot of content. I also fairly active on LinkedIn. So if you want to connect with me, happy to connect. I basically try to stay engaged and have constructive dialogues. And if anyone has any questions, things that you want to talk about, send me an email. My email address is in those websites, and I'll be happy to maybe make a video, a post, just try to answering some of these questions.
Well, dude, you got to get on Twitter already. I know I told
know,
you that
you've been
10
giving
months. Get
that's
on there.
The one thing I told my wife is I will not tweet. And I know it's irrational. I know I have friends who are doing it. I just feel like my medium is longer content, and maybe I'm just very verbose. I know I am, but I'm holding the line. Maybe you'll convince me eventually, but not this time.
All right. Well, eventually. Well, with that, Gary, stay safe. Good luck, and we'll talk again soon.
Thank you. Same here. Same to you.
All right. Talk to you soon.
Take care.